This is the retirement tax problem corporate executives don't see coming. How high income now creates higher taxes later, unless you intervene. Corporate executives are used to solving hard problems. They manage teams, budgets, strategy, and risk for a living. They understand compensation structures, incentives, and long-term planning, which is why retirement tax problems often catch them completely off guard. Not because executives are careless, but because success quietly builds a tax problem that doesn't show up until income stops. The very habits that create wealth during high-income years often create some of the worst tax math in retirement. Today, we're going to unpack the retirement tax problem corporate executives don't see coming, how deferred taxes hide inside retirement accounts, why good savers end up with worse retirement outcomes, the pre-retirement planning windows that matter most, and what executives miss when they focus on accumulation. Before we dive into all that, my name is Ryan Knoll. I'm a certified financial planner and founder of NAB Wealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's get started. So why does high income mask future tax risk? During peak earning years, taxes feel like a current year problem. You focus on marginal rates, bonuses, stock compensation, and optimizing deductions. Retirement feels far away, and tax deferral feels like an obvious win. Maxing out 401ks, using deferred compensation, rolling bonuses into pre-tax accounts are all smart moves at the time, and ones that you should continue to make. The problem is that tax deferral doesn't eliminate taxes, it concentrates them. And concentration is manageable when income is high, but dangerous when income becomes forced. This is why it's so important that for every dollar you defer now, you have an exit plan for it later. Now let's talk about deferred taxes hiding inside retirement accounts. Executives often arrive at retirement with a familiar balance sheet. Large traditional 401k and IRA balances, deferred compensation accounts, pensions or supplemental executive retirement plans, taxable brokerage assets, some Roth money, which is often smaller than expected, and stock-based comp that has been accumulating for years. What's easy to miss is that this is a significant portion of net worth which doesn't fully belong to you. It's shared with the IRS unless you manage it appropriately. Every pre-tax dollar is a future tax liability, and when balances are large enough, that liability grows faster than you expect, which means that good savers face worse tax math. And here's the paradox. The better you are at saving, the worse your retirement tax math often becomes. Why? Well, because large balances create large RMDs. RMDs stack on top of Social Security. Higher income triggers Medicare IRMAA surcharges. Higher taxes reduce net spendable income. And heirs face compressed taxation under the 10-year rule. This isn't a punishment for success, it's simply how the system responds to accumulation without coordination. The IRS wants you to have this problem. You are going to be their cash cow in a few years, and it's because you did everything right, which often forces equal or even higher effective tax rates in retirement than you ever paid while you were working. It's not uncommon for us to come across clients who made an income for over a couple of decades in the $300,000 to $500,000 range annually, project to have higher retirement tax burden than they did while working. Why? They no longer have options. Distributions are forced and necessary to maintain their lifestyle. They have huge unrealized gains on taxable accounts. The retirement accounts grow faster than they can take out. And this all comes to a head around age 75 when the government is going to force them to take money out. Oftentimes, it's more money than they'll even need to spend. Add all of that on top of pensions, Social Security, and even deferred comp in some scenarios, and you have the recipe for a tax nightmare. So why do so many people have the illusion of lower taxes later on in retirement? Many successful professionals assume retirement means lower taxes because their earned income disappears. In reality, retirement replaces earned income with required distributions, investment income, government benefits, deferred compensation payout and pensions, and in some instances, inherited funds with accelerated distribution schedules. The tax code doesn't care whether income comes from work or withdrawals. It all stacks on top of your taxable income the same exact way. This is why executives are often surprised when their tax bracket in their 70s matches or even exceeds what it was during their working years. So what does accumulation-focused thinking miss? Well, during accumulation, success is measured by how much you save, how fast assets grow, and how tax-efficient contributions are. But accumulation thinking misses critical retirement dynamics such as timing of income matters more than the amount of income itself, sequence of withdrawals affects lifetime taxes, Medicare and Social Security introduce income cliffs, and tax brackets aren't the only tax system at play. Focusing only on accumulation is like optimizing an engine for power without considering what the braking distance needed is to stop. And this all leads to pre-retirement planning windows successful professionals often miss. There are specific windows where executives have outsized control over future tax outcomes. and they often go unused. The early retirement gap, which is the years between retiring and taking Social Security or your required minimum distributions, are some of the most valuable planning years available. Income is often temporarily lower, creating space for Roth conversions, income smoothing, strategic asset sales, capital gains harvesting, and charitable strategies. If you miss this window, your options narrow quickly. Next is the Roth conversion runway. Waiting until RMDs begin is often too late. At that point, forced income limits how much can be converted without pushing taxes into inefficient brackets. And then finally, there's the Medicare look-back window. Income decisions today affect Medicare premiums 2 years later. Executives often ignore this until the surcharge arrives. What you do at age 63 will affect you at age 65. What you do at 65 will affect you at 67. So start planning at that point so you don't pay higher premiums any longer than you have to. So why do executives underestimate this problem? Executives are trained to think in terms of compensation, bonuses, and performance metrics. Retirement taxes don't show up on an annual dashboard. There's no warning label on a growing 401k, no alert when future RMDs cross the threshold, no preview of how heirs will be taxed, and accountants typically don't project for future tax burdens when they file returns. They just want to make sure you paid the right amount of tax on what you already did the previous year, so there's no forward-looking solution. By the time the problem becomes visible, many of the best tools are gone. This is why you need to either educate yourself before you get to that point or ask for help. Getting this right can be 6 to 7 figures of difference in taxes paid over your retirement plan. So whether that's the difference between retiring a bit earlier, buying that second home, or leaving more money to loved ones, it's not an opportunity that you can afford to miss. And before we continue on with the video, I wanted to thank you for watching our content today. We create videos like this weekly where we aim to educate and empower you to have a tax-efficient retirement. So please throw this video a like and subscribe to the channel if you find this helpful. Ask any questions you would like in the comments below and I'll do my best to answer them quickly. And for those of you who feel like you cannot afford to get this wrong, please schedule a link to meet with a member of the NavWealth team below. We focus not just on how to generate the returns you need for a successful retirement, but how to make sure you keep more of those returns through strong tax and retirement planning. We would love to meet with you. Let's jump back into the video. So what is the compounding effect of tax inefficiency? Small inefficiencies compound quietly. You have slightly higher tax brackets every year, Medicare premiums creeping up, reduced flexibility to respond to markets, and forced sales at bad times. Over a 30-year retirement, these inefficiencies can cost hundreds of thousands or millions in lost after-tax wealth. And this is exactly what we see with a lot of the clients who end up working with us. Let's go over a practical example. Consider a senior executive retiring at 62 with $4 million in pre-tax accounts, $1.5 million in taxable accounts which have a basis of $500,000, minimal Roth assets, and cash reserves of about $250,000. They need roughly $240,000 a year to live on. They want to take Social Security, which is $3,500 a month, no earlier than full retirement age, but they don't want to wait until they're 70. They also are divorced and facing condensed tax brackets. And unfortunately, they live in California and are facing high state tax rates as well. Without intervention, RMDs will push income into high brackets. Medicare premiums will spike at 65. Social Security income inclusion will be at the highest levels, and heirs are going to inherit large taxable accounts. With proactive planning, Roth conversions reduce future required minimum distributions, income is smoothed across decades, Medicare costs are controlled, and heirs receive more tax-free assets. So what might their plan look like? Assuming they didn't want to move from California and are not planning to get remarried, this executive is facing a huge tax burden. We would break their retirement down into 3 distinct phases. First is the Roth golden window between 62 and 67. Then there's Medicare planning, which coincides with the first window starting at 63 and goes the rest of their life, and then ultimately affects how they're going to take Social Security, assuming they take it at 67. Then there's the RMD distribution phase, which starts at 75. The first window, though, is the most important. We know that this individual likely cannot avoid IRMA. So at age 62, we want to make sure they're filling up a predetermined tax bracket. In this instance, the 24 bracket would probably be a reasonable target. It might not be optimal at this point, but it would just be a good, reasonable starting place. This will give them the income they need to live on and the ability to start conversions. Let's assume they draw down on their cash reserves by $100,000 and they take the rest of their income from pre-tax IRA money. They will have an AGI in this instance of about $140,000 at this point, and then which after their standard deduction gives them the capacity for roughly $75,000 in Roth conversions. They couple this strategy with harvesting losses in the taxable portfolio to create cash to fund taxes on Roth conversions and offset gains elsewhere in that portfolio. Let's assume this frees up an additional $200,000 of cash in year one, which they can then use to perform some direct indexing and tax loss harvesting against their taxable portfolio every year moving forward, further giving them a little bit more tax efficiency there. This taxable account strategy harvests about $25,000 of losses every year after year one and frees up capital tax-free moving forward to continue to fund living and taxes on conversions. Then Social Security will kick in at 67. This creates $42,000 of income each year, which eats into the ability to Roth convert by about $36,000 annually, as their Social Security is only 85% taxable. They're still going to target that 24% tax bracket, and Roth conversions are reduced to about $40,000 annually after all spending needs are met. Now we get to the RMD stage at 75. Had they done no pre-planning, their RMDs would have likely been $315,000 at 75, assuming an 8% growth rate on assets. This is the 32% tax bracket for a single filer, and they would likely flirt with the 35% bracket within 5 years, assuming the same growth. With planning, they are able to remain in the 24% tax bracket for a few more years, then ultimately top out at the 32% bracket. Over the first 10 years of their retirement, this should save them nearly $750,000 just on taxes. This is also when we could consider adding things like qualified charitable distributions or a donor advised fund if they're charitably inclined. Either would reduce their taxable income and allow them to take out funds at cheaper rates. Finally, this is where they need to get their beneficiaries correct. If they have children, make sure the ones in higher tax brackets get Roth dollars and those in the lower ones get the traditional dollars to take advantage of that tax delta. They would hold brokerage assets to receive the step up in basis at death and make sure they have all their charitable strategies in line to receive current deductions and leave a more efficient legacy. That's roughly how we would go about saving this client potentially upwards of $1 million in taxes in retirement. And to solve this problem, executives now need to treat this problem how they solve them at work. Executives are used to delegation, but only after strategy is clear. Retirement planning requires the same mindset shift. This isn't about tricks, it's about designing a system that works under uncertainty. The executives who do best in retirement treat tax planning like they treated their careers. Long-term, intentional, integrated, and reviewed regularly. What should executives do differently? The solution isn't abandoning tax deferral, it's balancing it. That means building meaningful Roth assets before retirement, modeling income across decades, not years, coordinating withdrawals, conversions, and benefits, and planning for heirs, not just their current lifestyle. It also means recognizing when accumulation thinking has reached its limit. The bottom line here is high income today creates higher taxes tomorrow, unless you intervene. The habits that make executives successful during their careers can quietly create some of the most challenging tax problems in retirement. Deferred taxes accumulate, planning windows close, and forced income takes over. The executives who avoid this outcome don't save less, they plan earlier and coordinate better. If you're a corporate executive or highly paid professional approaching retirement and want to turn decades of success into sustainable, tax-efficient income, that's exactly what the team does here at NavWealth Partners. Please schedule a call with us via the link in the description below. Thank you so much for watching, and as always, make smart money decisions.